Hello everyone, it's Alex Suslov, Head of Capital Markets, here with you for our AD Weekly Digest to share most recent market news, mortgage news and news for non-KM market. Today mortgage rates for conventional loans are at 5.6% and non-KM rates are well above 7% at 7.5 to 7.58. From the latest developments in the mortgage market, we see there is a battle going on between wholesale and retail lenders. UWM is actively participating in it, dropping its margins and just burning off their cash in order to get more traction, more clients towards wholesale business and try to steer those from retail. And doing this at these times when loan origination volumes are down is a good timing, but tough for retail competitors. In non-KM market, we're getting more traction on short-term rental properties for DSCR and AD mortgages, going towards accepting those using either Airbnb 12 months historical rental values or automated systems like AirDNA in order to verify property cash flows. And we have Billy Abrams here with us today to give us a market wrap on the coming economic news, on what happened in the past week and what we should expect from Federal Reserve for the coming September meeting and for the rest two meetings this year. Billy, how are you today?
I'm good, Alex. How about you? It's always good to come back from a 3-day weekend. Had some excitement last week after yields basically ground higher for the entire month of August. September 1st came and they spiked higher, and actually at that point the 5-year and 10-year had given back 80 to 85% of their rallies that began on June 14th and ended on August 2nd. Actually the 2-year made a new high yield above the June yield crest. Although the 2-year is so close to Fed funds, I don't do much technical work on it. At this point, however, the 5-year and the 10-year have they've satisfied objectives that we've talked about, that I've spoken about last several digests and written in my market updates. And these are objectives that satisfy the moves up, presuming the treasuries are still in corrective moves that began in June. That's always been my preferred count. Not so certain about it right now the way they've gotten here, but we'll have to see how the maybe next week plays out. We'll have a much better read on it. The fact of the matter is that yields were up as much as 25 basis points just since the last digest after Thursday, which was the day they opened with the big spikes. They've settled back a little bit since then. Whereas we came in 2 weeks ago, the news was all about the Fed. This past week figured to be all about jobs reports. And as far as all the other economic reports last week, by my count there were 16 of them and only 4 came in bearish, and yet yields rose as much as 25 basis points. So I think the markets needed to see these moves up in yield. I think we needed to test the June highs, and now what we need to figure out is whether they're going to hold or whether we're going to go on through those highs. I remain unclear as to whether we are about to go through the June highs or whether we're going to have a secondary rally, which had been my preferred count all along. So I think the next week will tell us, the next couple of days will tell us. As it is now, it's going to be a wait and see game. The numbers this coming week are not all that important, and they're not all that many. With that, I'll kick it back to you, Alex, and we'll see how things go.
Billy, thank you so much for the overview. So this week is gonna be pretty short, not that many of events. Looking forward to the Fed meeting in September. Thanks everyone. It was Alex Suslov, Head of Capital Markets at AD Mortgage. Make sure you stay tuned to all the news from AD. Sign up to our YouTube channel, sign up to Billy Updates, and stand up of the most recent market updates on the mortgage market, economy, and non-KM. Stay tuned.